Tuesday, July 30th, 2024. This is the Arlington County Board of Equalization hearings. There are 6 cases on the agenda that we will hear, and let the record show that there are 5 board members present at this time. The first case is RPC 15074-005. Property is located at 3141 Wilson Boulevard. Mr. Portillo, you can start with your 8 minutes and tell us about the properties.
Sure. So this property, like you mentioned, is located at 3141 Wilson Boulevard. Currently, it's being assessed at $10,176,767. We're asking for $9,702,810. The reason we're asking for that is we don't believe that the guidelines are being applied uniformly to this property. It's listed currently as a 211 property. And if you look at the guidelines, the expense rate for that type of property is 15%. However, if you look at the assessor's worksheet, only a 12% expense rate is being applied, or $90,396. If you put the expense rate at 15%, like the guideline says it should be, the expenses would actually be $124,995, which would then give you a value of $9,702,810. We don't disagree with the PGI or vacancy or anything else with a cap rate. All we're saying is that the guidelines should be uniformly applied to this property. That's all we're asking for. I yield my time.
Okay, thank you. Ms. Roskin for the county then.
Thank you, board. I want to open up saying that we do not believe that this appeal should be heard this morning on the basis that we have not received sufficient documentation in order to provide the information. And that documentation is the lease agreement that allows the tenant to appeal this assessment. Please understand that the agent is representing the tenant and not the owner of real estate. And I did send a request out early on. I think it's on page 17. You'll see in the email, and it's also in the first 3 paragraphs where I comment that we requested, we said, okay, if you can provide a snippet of the lease agreement that shows CVS has the right to appeal. You also need to show the lease dates to make sure that it is current, and an LOA from the owner of real estate, then yes, we can hear your request. But they never provided that. CVS came back and said, no, you can't have a copy of the lease because it's proprietary information. So I'm starting off with, I don't believe this should be heard today. And that is why the summary page that was presented to you does not show any income and expense information for the years 2020, 21, 22, and 23. Now, yesterday, you did receive a copy of a summary page that I created in preparation, when I'm looking at these appeals, and only the board members have that because of the confidential information on it. We cannot disclose that to the tenant. And if you take a look at them, you'll see that our January 1 NOI is less than all 4 years. All 4 years, you'll see that our NOI is substantially less than what's being reported. I did talk to the CFO who filled out the income and expense information to confirm data. Not only does this tenant, first of all, it's not a ground lease. Okay, this particular one is not a ground lease. But not only do they pay rent, but they also pay the real estate tax bill directly to the county. So in a sense, that's the same thing as reimbursing it to the owner, and the owner turns around and pays the bill. It's the same thing. So there's no difference. So we feel that our January 1 assessment is well supported. And once again, we do not believe that this case should be heard today because the tenant, or not the tenant, the agent did not provide sufficient documentation. Thank you.
Okay, thank you both. Any questions from
Can
board
I
members?
just add something?
Briefly? Deidre?
It's fine. No, it's fine. Thank you.
Okay, all right. Mr. Penaranda?
Yes, good morning. Madam Chair, I agree with the county. I don't, I normally, when I review cases, that's the first thing I do, make sure that the authorization letters are in place. And I don't see any authorization letter in the proper way that we normally request from every appellant. There should be a name, addresses, phone numbers of the owners. The only thing they have is a blank a blank statement authorizing everybody to just appeal or revise or file or do things, which was signed by Ms. Gloria Parental. But I think she needs to revise and abide by the rules of each jurisdiction. And I think, I don't think we can properly hear this case or the next one because they both have the same situation.
Okay, Mr. Matskin?
Are we in Q&A or are we in wrap up for our own internal commentary?
Or in questions?
All right, because that wasn't a question. I got confused. I'll wait. Thanks.
Okay. Mr. Lawson?
Yeah, hey, this is for the county, for Lori. You had a paragraph, they can provide a snippet that shows CVS has the rights to appeal. Was that ever provided?
No, sir, it was not.
Whoa.
Okay, any final questions? All right, any last comments, Ms. Ruskin?
No, ma'am.
Okay, Mr. Portillo, any final comments in your minute to wrap up?
Yes, so the reason it wasn't provided, we don't have authorization from CVS to provide the whole lease. And like I mentioned, or it was mentioned that we can provide a snippet, but we were told that would not be sufficient, so that was never sent. Otherwise, I have no problem, and CVS has no problem providing a snippet saying that they have the right as part of the lease. But as it stands, we can't provide the whole lease. Because that is proper proprietary information. So I don't have authorization to do that, but I do have authorization to provide a snippet.
Okay, it's just among the board. I mean, I agree with Mr. Penaranda. We don't have authorization, and generally, I mean, the code says if you don't provide the information to support what the actual income and expenses are on the property, then you can't question what the actual assessment is. So, my feeling is to hear it is rewarding bad behavior. Mr. Matskin?
Yeah, I'd just like to add on to that, not only don't we have anything to compare it to, but that snippet, had we received it, we still wouldn't, as the department mentioned, still don't have verification that it's current. Finally, in our second, hearing it today, the department's mentioned that several times, shouldn't hear it today. I think that the appellant and the owner have adequate time to provide us with the key information that we require from everybody. And I think today is come and gone. And I wouldn't like to see this again if somehow something loosens up in the future. I think this is now overtaken by events.
Right, and I don't want to speak for everybody, but my feeling on just having a snippet is you don't have all the terms. You don't know if you have all of the agreement or what the deal is between the parties. So I myself would not want to act on a snippet of a lease. So
even if we didn't have even if we had that information, I'm still going with the letter of authorization. Right. They can use their own form, they can use their own format like other appellants do, but they should have the information that we request.
All right. That being said, that I'm going to move to confirm the county. Do I have a second?
I'll second that.
Okay, a motion, a second by Mr. Penaranda. All in favor?
Aye.
Aye. Opposed? Okay, it's unanimous. The county is confirmed at $10,176,800. Okay, the second case on the agenda is RPC 3600802G at 2400 Richmond Highway. I believe we've got the same issue here, but Mr. Portillo, if you want to take your 8 minutes and tell us anything differently.
Nope, I yield.
Okay, anything different from Ms. Roskin?
No, ma'am, we are still in the same position.
Okay, all right. Any questions from the board members on this? Can we move right to a vote? Okay, Mr. Yates? Can you turn your microphone on, sir?
Lori, real quick, who filed the appeal?
The agent did on behalf of CVS, the tenant.
So are we even correct in confirming this when it's not even been appealed by the property owner?
That's correct. That is, excuse me, that is our stance. That they did not provide, and when we were asking for a snippet, we said, if you can provide a snippet that states, the conditions that allows them the right to appeal and a letter of authorization from the owner of record, then under that circumstance, we could hear this. They did not do that. They only provided a letter of authorization from the tenant, and that is not adequate for us.
So this should be on the agenda.
Correct.
Okay. Any final comments from either party?
No, ma'am.
Okay, well, again, without having the authorization or the information, I'm going to move to confirm the county's original assessment of the property.
Second.
$5,364,500. Is that Mr. Lawson? Was that a second?
Yes, ma'am.
Okay. Motion is second by Mr. Lawson. All in favor?
Aye.
Aye. Opposed? You're opposing this, Mark?
Only because I don't think it should be even before us. There's no appeal.
Okay, all right. We still have to act on it, so. All
Yeah.
right, so that's 4-1 with Mr. Yates voting no,
Right or wrong?
not to hear the case. Okay, so the county is confirmed at the $5,364,500. Thank you. Okay, do we have Mr. Harmon on? And Mr. Portillo, you can turn off your camera. There you go. Okay, next case on the agenda is RPC 1000103G on Washington Boulevard. Mr. Harmon, you can start with your 8 minutes and tell us about this property.
Yes, thank you, Madam Chairwoman, members of the board. Lori, good morning. This is the Westover Shopping Center located at Washington Boulevard in Westover. The issues on appeal are the potential rental income and the operating expenses. Now for the income, if you'd kindly direct your attention to page 5 of the appeal pack, you'll see the rent roll as of December 31st of 2023. The total rental income at the property as of the date of value is shown at the bottom of this page as $1,264,203. This consists of two parts. It's the general retail, and then the post office is separated out on its own. This is exactly how we've done it on the appellant's pro forma as well. Now, going back to page 4 of the appeal, you'll see again, that's how column F, the appellant's pro forma, imputes these exact figures for rental income. However, if we go over to the county's assessment in column D, we see that column D imputes an additional $33,000 in rental income for the general retail portion of this property. Now, I'm not sure what exactly the additional $33,000 in rental income the county's imputed is related to, but it's clearly above and beyond what the rent roll shows as of the date of value. For the expenses, the county's imputed a value that is $120,000 lower than what the property actually incurred last year. You can see this by comparing columns D and E1. Now, the county provided a reconstructed column where tenant concessions and a couple of other nominal expenses were removed from operating expenses. This is shown in column E2. Even if we accept that reconstructed column with concessions removed, we can see that the county's operating expenses imputed are still $81,000 lower than what the property incurred in 2023. This, of course, is before factoring in any inflation that will be incurred in 2024. Correcting for the income and expenses gets us to the appellant's pro forma in column F. Here, you will see rents imputed at the actual rental rates as of the date of value. Pass-through income was imputed at the 2023 actuals. Vacancy and collection loss was taken at the county's market rate of 11%, which is in accordance with Virginia law. I want to also mention that appraisal practice states that you must take a market vacancy rate when creating an income approach to value. The county has told us the market vacancy is 11%, and this vacancy and collection loss is required, again, both by appraisal practice and by Virginia law under equalization. Even though this property is fully leased, does not mean it will not incur any collection loss or other interruptions to the income stream throughout the course of the year. Next, expenses on the appellant's pro forma, we imputed at the 2023 rate plus 3% to account for inflation. Finally, we did not contest the county's cap rate of just under 6.3% for this property. Thank you.
Okay, thank you. Ms. Roskin for the county, please.
Thank you, board members. Thank you, Jordan. First of all, yes, we did provide a rent roll analysis, and I looked at the rent. After reviewing the 2023 income and expense statement, and yes, I reconstructed it. There were some expenses that didn't belong in there. They're not typical operating expenses for the annual operation of this property. So after looking at this, I looked at, okay, yes, we're slightly above on the gross potential. And then we applied the stabilized vacancy rate of 11%. And that brought our EGI down substantially less than what's being reported. And in the end, when I looked at our January 1 NOI, and I compared it with the downward trend that I see, a minor downward trend, it's nothing substantial, but a minor downward trend from the 2020, 21, 22, and then looking at the revised 2023 column, and I compared our January 1 NOI, and I said, okay, we're in line here. And that's why I felt that it wasn't necessary to provide a test column. And we believe that our January 1 assessment is correct. We also went a final, after the final value, after the cap rate and the value of $17,020,700. If you're aware, there is a parcel that abuts, a residential parcel that abuts this property, and a portion of it is used for parking for the Westover Shopping Center. And so that's what the calculation below the line adjustment is for. The $384,100 is to ensure that there is no double taxation. We subtracted that value from the residential parcel and making sure that it was not counted twice, if you will. And so we believe that our January 1 assessment is correct. Thank you.
Okay, thank you. Questions from board members? Mr. Lawson.
Yeah, this is for Mr. Harmon. Mr. Harmon, are there issues with the parking?
It is limited parking. If you're all familiar, I'm sure you are with this. As you go down Washington Boulevard, most people try to park off the street. There's also an issue with the Italian store abuts this property, but is not part of this property. So I know that the Italian store draws a lot of customers and sometimes takes up more parking than for other shops in the property. But again, the Italian store is not a part of this property, but that's my knowledge of the parking issue, Mr. Lawson.
Okay, any other questions? Okay, Ms. Roskin, if you take a minute to wrap up, please.
Once again, after reviewing the 2023 reconstruction And looking in the downward trend that I see, it's a minor downward trend for the previous years in comparison with the 2023. We feel that our January 1 NOI is in line and that our assessment is correct. Thank you.
Okay, Mr. Harmon, any final comments in your minute?
Yes, thank you. So we see on property after property, we don't assess based on actual, we do a stabilized potential. With this property being fully leased, what the county has done with their stabilized potential is taken 11% vacancy and collection deduction. That's uniform. What's not uniform is the county then goes back and tries to claw back that deduction by bumping income by 30,000, reducing expenses to over 80,000 below what the property actually incurred. That's not uniform. They're just, saying it's fully leased. We're going to go to actuals, try to get our assessment to actuals. That's not uniform. Properties are assessed on a stabilized basis, which includes a market vacancy rate. That's what they imputed, but then they claw it back by bumping income, by reducing expenses. We ask that actual income, actual expenses be used. Thank you.
Okay, thank you both. All right, it's just among the board. Very stable property. Mr. Matzkin.
I thought that was right, that the last thing about the operating expenses. It's a stable property. It's probably not going to anytime soon or for any certainly length of time experience 11% vacancy, but that's the guideline. That's the standard. We do that all the time. We apply guidelines even so that we don't have to tell the fortune of what's coming in the beginning of the year. Having said that, I like the original column D. Again, stabilized property, not all that difficult to forecast without the 2023 INE, what was going on there. But what I didn't like was the total operating expenses on column D. I thought that was unnecessarily low. So I just took an average of the last three. Again, stable, stable, stable. I don't want to forecast inflation or the Fed funds rate or any of that stuff. And so I got, instead of 196 plus thousand, I got 209 plus thousand operating expense. So that difference of whatever is 120 some thousand, I just deducted that from the NOI, and I didn't get to the final number, but I would like to have, I can certainly do that, cap that final number out, and that's what I would feel more comfortable with as the final evaluation.
Okay,
Just
Mr.
again, just
Mr.
changing.
Lawson?
Yeah, Ken, I did the same thing, only the figure I used for expenses was the one in column E2, which was the reconstruction. And so I did it all the way to the end and ended up at 15,543,297. So I did similar to what you did. Your expenses were a little, I think you said it was 209. And I used the reconstructed amount.
Meaning 277?
Yeah, 662. When I took it all the way to the end, I got 15,543,300.
Yeah,
I
well,
don't
that
know.
is closer to what they experienced in the past year. Maybe that's perfectly appropriate.
Yeah, I don't know how the rest of the group feels.
Mr. Penaranda? Can you turn your microphone on, sir?
Yeah, sorry about that. Yeah, I'm pretty much in line with both Mr. Matzkin and Mr. Lawson. I did the same as what Mr. Lawson did. I came up with almost the same number, except by a couple $100. I came up with a final value of 15,543,497.
Oh, I'm off 200.
Yeah, I used the same number, and I thought it was more appropriate than just to do an average, because I think it comes up still a little lower than what they're experiencing.
All right, well, we're very close. So
it's a final comment that I'll make is, yeah, it's fully leased, but they also tend to lease under the market. I represented the Westover market, and because of that, I got very involved with what how the landlord was helping them as they were trying to get the approvals.
Right, well, that would be reflected in the rent, so,
Right.
okay.
Yeah. I just redid the numbers and it does come up with 15,543,497 if we do that.
So it would round to 500, okay,
Right.
all right. Is everybody in agreement with that?
Yes.
All right, Mr. Penaranda?
Sure. I'll move that we reduce the assessment to a final value of 15,543,497, and that's by using the expense amount from the reconstructed column.
Okay, do I have a second?
Second.
Okay, Mr. Lawson is a second. All in favor? Aye. Opposed? Okay, and that was with rounding. That is reducing it to 15,543,500 based on the expenses that were actually incurred and reconstructed in E2. Okay, thank you. Okay, the next case we're taking out of order. It's actually the last case on the agenda, RPC 2300602G. Mr. Chicas is not with us and Ms. Roskin is going to present this property. So I'll give everybody a second to get the right case up. Okay, Mr. Harmon, you can start with your 8 minutes and tell us about the property at 3401 Columbia Pike.
Yes, thank you. So 3401 Columbia Pike, this is a development site plan approved for 250 multifamily units and 5,000 square feet of retail space. This property is at the northwest corner of the intersection of Columbia Pike and Glebe Road. The issue on appeal is the county's guideline land rate for multifamily land. As background, there are 3 approved approaches to value for assessment purposes in Virginia. These are the income approach, the cost approach, and the sales comparison approach. For site plans, the county uses the sales comparison approach because the other 2 methods are not applicable, since a site plan, of course, is not producing income, and you're not valuing any improvements that have been built on which to assess a cost. What you're valuing is the potential to build. Throughout the years, as sales supported different land values, the county has adjusted the guideline land rate accordingly. The county increased the land rate for non-metro multifamily land, such as the subject, in 2015, in 2016, and again in 2017, that rate was increased. Then in 2018, the county decreased the rate for non-metro multifamily land. These changes were based on market sales of multifamily land. Last year, there were multiple land sales of multifamily development land that support a decrease in the guideline rate for this type of property. Now, we heard on the county's commercial briefing in early June that the county did not complete a land analysis for this year, despite there having been land sales in the county. Now, we did do a land analysis. There were 2 primary land sales in the county in 2023, 4420 Fairfax Boulevard and the Roslyn Gateway project. For this property, 4420 Fairfax is more appropriate as a comparable because it's more similar. It's entitled to 237 apartment units and just over 9,000 square feet of retail. The subject, by comparison, is 250 apartment units and 5,000 square feet of retail. So very similar entitlements, just different areas. 4420 Fairfax is, of course, metro accessible. The subject is not. 4420 Fairfax sold in a widely marketed transaction in March of 2023 for just over $11 million, which works out to $44,500 per approved multifamily unit that's metro accessible. This compares with the county's current guideline rate for multifamily land that's metro accessible of $86,000 per unit. So 4420 Fairfax sold for 52% of the county's guideline rate. Applying the same rate of 52% to the county's non-metro guideline rate of $60,000 per unit gets us to a fair market value of $31,000 per unit, which is the requested value. We did not adjust the rate for retail, general commercial FAR. Now, as you may recall, 4420 Fairfax, the county has vehemently argued for each of the past 5 years that that site plan is indicative of a fair market site plan. So we need to apply the fair market value of that widely marketed sale to other land parcels in the county. Now, the board also heard from an owner appealing the value of the Bingham Center in June. That property, as you may recall, is a site plan in Clarendon. It's at the intersection of Washington Boulevard and Wilson Boulevard. It included apartments and a hotel. The Bingham Center, as you all heard, was assessed for this year at $58 million. And as the owner stated at the hearing, was shortly about to go under contract for only $27 million. That sale price represents only 47% of the assessed value. So this is a second data point showing the county guideline rates need to be updated because as they stand, they're assessing properties at double what the market actually values them at. Now, a 50% drop in value, that's shocking. That's hard to believe, but that is the current state of the market. Now, why is apartment land so much lower than it was just a few years ago? Well, there's several reasons behind this. First and foremost is supply and demands. Fundamentally, these apartment buildings are investments. The less supply and the greater demand, the more value. Conversely, the more supply and the lower demand, the lower the value. Looking at supply and demand, apartment supply in Arlington County has exploded since the beginning of 2020. Apartment supply in Arlington County has increased by 21%, which includes under construction properties. So since the beginning of 2020 to current, supply has increased 21%. This compares to population change of less than 1% over that same period. So we have explosive growth in supply over 20%, met by a muted increase in demand, less than 1%, results in less favorable financial returns for developers, which in turn lowers the value of apartment land. Secondly, interest rates have an outsized impact on the value of development projects as well. Interest rates have increased over 4% since the beginning of 2022. Site plans are particularly impacted by interest rates because construction loans have a much higher risk profile than those for stabilized assets. So owners who are going to develop properties are going to pay significantly more for a construction loan than somebody would purchasing an already built apartment property. Add to that, in order to get to buy off the construction loan and move to a regular loan, they have to get the property stabilized. In order to get it stabilized in a market that has seen 21% growth in supply, you're going to have to offer significant concessions, and it's still a big if you're going to get stabilized in time to refinance. Third, construction costs have increased dramatically since the beginning of 2022 as well. The Delta Associates Market Maker Survey of DC area investors estimates apartment construction costs have increased over 25% from the beginning of 2022 to the end of 2023. So there's multiple factors working against both existing apartments and particularly apartment development land. We have a 21% growth in supply that's met with only a 1% increase in population. We have a greater than 4% increase in interest rates, which of course impacts construction development projects more so than anybody else. We also have a 25% increase in construction costs. These obstacles are reflected in market sales of multifamily land and need to be reflected in the assessment for the subject property. When doing a sales comparison approach to value, we cannot ignore sales in the market. The county's guideline land rates need to be updated to reflect the market sales that have occurred. That is how we arrived at our appeal value, is based on the market sales. Thank you.
Great, thank you. Ms. Roskin for the county.
Thank you, board members. And once again, I am presenting on behalf for Chris Chikas this morning. I want to make note that this particular property was approved for a special exception on, let's see, when was it? It was like June. No, I'm sorry. It was approved February 18th, 2023, this last year. And so we valued this property. Although the January worksheet shows that it was valued differently, that was an error. We made the correction through an own motion this year, and we valued it as as if it were site plan for, with the special exception approval. And that is the 60,000 per unit for apartments, non-metro, and then $55 a square foot for the retail, non-metro. And I want to state that, first of all, the entitlements for this property are valuable. They are transferable. When we are referring to sales in the market, we have a number of site plans that are consistently being approved. The apartment market is very robust right now. To say that it's slowing down is not true for Arlington County. It's very robust. Rents are still increasing. Construction is still moving forward. Site plans are still being approved. As for the sale at 4420 Fairfax Drive, this particular property was more of a leasehold sale and not the fee simple. There was actually a lease in place for a school, and we determined that there was no kick-out clause. So the owner can't do anything until the tenant, it's primarily the school, until the school moves out. So they're basically stopped. They're at a halt until they leave. As for other sales in the market for mid-rise, we have a number of properties that sold at $183 a square foot. I mean, per unit, excuse me, 183,000 per unit. Make that correction clearly. We have another one that sold for 287,000 per unit for mid-rise. And another, let's see, another one, the Columbia Crossings Apartments, that one sold for $449,000 per unit. We believe that the January 1 assessment, or the assessment is correct, valuing the property at 60,000, valuing the land basically at 60,000 per unit, 250 units, and $55 per square foot based on a 5,000 square foot retail space. And then there's only a $1,000 interim value. Thank you. Does Deidre, would you like to add anything?
Thank you, Lori. I just want to just point out again, reiterate the sale for 4420 North Fairfax is a special sale. This sale was encumbered by a lease of the Arlington Community High School. That lease is in place until 2026. So there are some special circumstances surrounding that particular sale. Also want to just reiterate the health of the apartment market in Arlington. I'm not really sure when you compare that market to markets outside of this metropolitan area, there may be a slowdown, but we are continuously seeing site plans and lease ups are within a year. So that gives us a healthy indication that the market is strong in Arlington County. That's all I want to add to that. Thank you.
Okay, thank you. Okay, questions from board members? Mr. Matzkin.
Question for the department. The appellant talked about site plan and the one sale, which Ms. Kelly expanded on further as being much, much lower than what you've assessed this particular property at per square foot, FAR square foot. But then you came back and talked about sales of, I believe, and this is what I'm asking, finished mid-rise apartment buildings at 180,000 plus or minus. So if am I right so far? I mean, you're doing finished buildings, the improvements are selling for 180,000 versus the appellant's 60,000 per FAR foot, just potential. Am I right so far?
Yeah, I was just making a comparison. Yes,
Yeah,
they are
so
finished.
so
Yes,
the
they are
difference is-
finished, and this is not.
Okay, okay.
Correct.
So the difference is then the value, just taking those two numbers, 180,000 let's say, plus or minus 60,000. Is the difference of the value of a finished unit, the difference between those two about 120,000 per unit? That just seems incredibly low. I must be missing something.
Mr. Harmon was correct that the department has not conducted a land analysis for apartments in some time, and that's the case for most of the commercial land. We will look at that for 2025. I think that the point is that the $60,000 is just very low. This property was valued consistently with other site plans, but we do need to adjust our per unit land rate. And right now that's $60,000. Lori was providing sales of where land per unit land is currently, just showing that we are not currently in line with where the market is.
Oh, so it's the 180,000 plus or minus is land, not finished improvement.
That's what those properties sell for per unit. So we break it down by per unit. So yes, that would be the case per unit. We don't break out whether it's, I'm going to say yes, the property is improved, but we break it down as a per unit rate when we look at the sale, and those sales were valued at a per unit of $180,000.
Versus land. We're talking about land for this appellant. And
yes.
The comparison is not for land, but for improved property. So yeah.
I know we're mixing the two and typically don't. I think the takeaway to this is that the $60,000 is actually low for where we are. When we look at current land, the land is much higher. They're over $100,000, and that this site plan is typical of how we value site plans for other properties that are encumbered by that have these entitlements for this year. We value them all consistently.
So that 100,000 figure that you just mentioned, is based on reasonably current sales of
That's
land
correct.
that is going to be converted to. Okay, great. Thanks a lot. That's what I wanted to know.
I believe that's completed apartment complexes. That's not pure land plays, just to clarify.
Okay.
Right.
All right,
That's what I'm
other
trying to
questions
ferret
from board
out.
members? Okay, Ms. Roskin, if you take a minute to wrap up, please.
Sure. Once again, I just want to reiterate that Arlington County has a very robust apartment market. Nothing is slowing down. We have a number of site plans that are in the pipeline that are going forward, and that one particular sale at the 4420, we do not believe that to be representative of the market for land sale, as that is a leasehold. There is no kick out clause for the school. So the owner, when they purchased it, they understood, okay, yeah, we have to hold out. We have to wait. We have to sit on this property before we can do anything. And we believe that our January 1 assessment, using the 60,000 per unit and the $55 per square foot for retail is correct. Thank you.
Okay, Mr. Harmon, if you take a minute to wrap up, sir.
Yes, thank you. Looking at land sales, multifamily land sales, we see that they're coming in at 50% of the current assessed value. We have both 4420 Fairfax Drive, which over the past 5 years, the county has come to the board and said, there's no special exceptions. There's nothing unique about it. It's like every other one in the county. Now that doesn't benefit them because it's sold for half the value, they're saying the opposite. That is indicative of the market value. We have the Bingham Center sold for 48% of the current assessment. We have Roslyn Gateway sold for much less than the current assessment. Land values are not as multifamily land value, office land value is not as valuable as it was 5 years ago. Multifamily land, of course, supply has increased 21%, population's increased less than 1%. The economics with interest rates and construction costs do not make as much sense as they used to. That comes out of the land value. Thank you.
Okay, thank you both. All right, it's just among the board. Mr. Lawson.
Yeah, I'll go ahead and start off with some observations. I think that Lori's right. There are a lot of site plans being filed and processed A lot of owners are using this kind of down economic time to go ahead and get approvals. We have a county board that's been very encouraging with additional density. And so people are taking advantage of that. So Lori is right. A lot of site plans are being processed, being approved. But I think what you have to look at is who is getting building permits subsequent to that. And the only project, and I'm sure there's others, but the only one I'm aware of going forward is one being done by Orr Brothers. And what they've done is on that particular project, they're reusing a garage. And according to David Orr, that's the way that they've been able to make it make economic sense. That and to do what's called stick built, which is to keep the height down such that you don't have to have concrete. I was in a meeting just yesterday with a man, you all may know him, Gary Rappaport. And the purpose of the meeting was, are we going to go forward for my client on a approved residential building? And Gary was analyzing or predicting the future. He said, right now you can't go forward. It doesn't make economic sense. However, there's a lot of feeling, according to him, amongst the predictors of these things, that interest rates are going to go down as we near the election. And after the election, the consensus is that interest rates will continue to go down. Tom Schultz's project, which has been talked about, what Tom did is he emptied all his tenants, so he kind of had to make a deal. As far as the 2026 lease, it takes about a year to get your building permit, so the owner of that's only sitting on it for about a year. The bottom line of all my talking is that a site plan, a property owner is not going to give up a site plan to not pay taxes. Costs too much, takes too long to get them approved. So there is a value to that site plan, and it's not as low as Mr. Harmon is indicating, but it's not as high as Lori is indicating. It's in between. And I know we've had this discussion before, and so I tried to come up with what I think is a fair increase in the value of this property based upon a site plan use permit that someone can use at some time in the future. And I'm just going to throw this out. I may not get any support, but I think it's, what I did is I took Lori's figure and I just multiplied it by 80% for 220,800, and I'll see if anyone agrees.
Okay, well, I'll jump in. I unfortunately do not agree with you. I agree with some of the stuff that you said, but not all of it. I look at this, and as you said, nobody's got a crystal ball. And if, as you said, people are going ahead and using this downtime to get site plans, they do it knowing that it is going to be assessed at the county site plan rate. So that's a business decision that they make to hold on to it, or to do it in advance to have it ready. And I will agree when you said that there's values to these site plans. I mean, I look at this and I think, at 60,000 a unit, that's not high. I mean, I think that's low. I mean, to be down at 31, I think that that's absurd. And I'm not comfortable with just arbitrarily picking a number and saying, oh, it's a bad time, so we'll go ahead and lower this. The site plan is a site plan. It's assessed on that. They know that up front. That's a cost of doing business for them. And I'm therefore okay with the county's value of the 15 million, but interested in what other folks have to say. Mr. Penaranda? Turn your microphone on, sir.
Sorry again. Yeah, I agree with you. I think, we've seen many cases that come up with site plans, and all of a sudden, because of management decisions, they are not going to do anything for the next 2 or 3 years. I don't know how quick they're planning on moving on this project, but I know they vacated the building pretty quick. So it's hard to tell what management is going to do in the near future. It could happen very soon or not. But yeah, I agree with you. I think based on the site plan and the rate that they're using, I'm okay with it. And yeah, just picking a number just to compromise, I'm not comfortable doing that.
I don't think it equalizes the other people in site plans
Right.
Right.
either. Mr. Metzger?
I'd like to add one other thought, and that is that the other multifamily buildings that we have seen this year all show, let me start off. I've heard the same statistics that Mr. Harmon put out, namely that the increase in population last year, 2 or 3 in Arlington is minimal. He said 1%. I buy that. Whereas the amount of residential is significantly more than that. He said 21%. Nonetheless, having said that, nonetheless, we are seeing appellants again and again and again, multifamily resident appellants that are doing okay. They're not taking off, but they're more than a couple of percent better this year than last year. And we're, of course, at January 1st, 2024. And based on what we see, there's no reason to believe that the value of land to become multifamily has decreased over the last couple of years. And as we all know, it's been the same and that over the last couple of years. And that seems to make sense based on, again, the appellants that we've seen so far in a similar situation. So I support the county's assessment.
Okay. Mr. Yates?
Yeah, I totally agree. This is an equalization issue. I do hear what the appellant's saying as far as some of the numbers, but everything we've seen on other projects or appeals does not indicate this market's hurting and values are dropping.
Okay. All right, well, and that being said, I'm going to move to confirm the county. Do I have a second?
A second that.
Okay, Mr. Penaranda. Motion and a second on the table. All in favor? Aye. Opposed? Okay, so that is 4-1 without Mr. Lawson. The county is confirmed at 15,276,000 even. Thank you.
Thank you.
Okay, do we have Ms. Shuttlesworth? I believe. Okay. All right, so the next case on the agenda is the fourth on the agenda, RPC 250170098 at 2301 Columbia Pike. Mr. Harmon, you can start with your 8 minutes and tell us about this property.
Yes, thank you. This is the Sienna Park Apartments located at Columbia Pike, just east of Walter Reed Drive. The issues on appeal are the potential rental income and the cap rate. For this property, the county did not provide a test sheet. However, you can see the initial assessment on page 39 of the board pack and the test on page 4. What these show is a growth in potential income of 5.6% from 2023 on the current assessment and a growth of 3.4% on the test. Now, Virginia, as I'm sure we're all aware, has a specific statute specific to multifamily properties that states actual income shall be considered. The county has been provided with actual 2023 income and expense information on 2 occasions. First, with the I&E submitted by the owner on March 15th of this year, then a second time when the appeal was filed a month later on April 15th. So this information is there to be used, and we respectfully request the information be used. We've seen this, as was the case on the first few multifamily properties heard at the board this year, where we saw the county's test columns did come in right around the actual operations of the property. Next, in regards to the cap rate, the standard of proof under Virginia law is a preponderance of the evidence. Once a preponderance of the evidence shows the county's assumptions are incorrect, the burden shifts to the county to prove that their assumptions are correct. To start, on page 24 of the board pack, the county notes that sales in the county in 2023 closed at cap rates as low as 4.8%. Looking at the 2023 sales, we know there was only one comparable property to this property, and it closed at a cap rate of above a 6%. So it appears, based on the other sales that occurred, they were all $2 million sales thereabout. The county's relying on those to get the low end of their cap rate support. They're relying on $2 million multifamily sales, which of course are not comparable to the subject. You'll see those units, they're 8 units, 10 units. The subject is 188 units. It's not comparable to those $2 million sales. Those should not be used to support the county's cap rate. Rather, the one comparable that is listed is the Jasper on Columbia Pike, which sold for over a 6% cap rate. Next, on page 23 of the board pack, the county has included a chart of multifamily sales in Arlington County. This chart includes several 2024 sales, and I've recreated this chart. I'd like to share my screen, show this chart to you. So the highlighting is mine. I've added that, and I also want to state this is great that the county wants to consider. They're clearly stating we want to consider 2024 sales as a check to the current guidelines. We need to apply this same logic to office sales in the county as well. I'm going to focus, this is the 2024 and 2023 sales that occurred in the county. The highlighting again is mine. You can see here the red highlighting are the non-comparable properties. So you have an 8-unit, $2 million property, $4 million property. They're all very low values, not really comparable to the subject. So again, this one's 188-unit mixed-use property. We're significantly more than $2 million. So I've highlighted the non-comps in red. And then I've removed them on this page. These are only the comparables for 2023 and 2024. Looking at 2023 sales, these bottom two, you can see that the county's ASR was well above the actual sale price in 2023. So we know 2023 sales were much higher, or 2023 sales were much lower than the assessments. How does the county's assessments stack up against 2024 sales? Well, that's on this page. What's interesting about the 4 2024 sale comps is that 2 of these 4 properties were reduced on appeal in 2023. That reduced value is what the 2024 assessments were based on. So what the chart that the county has provided as support for the guidelines is showing is actually supporting appeals. The 2024 assessments listed are indicative of successful appeals. If we're going to use the 2024 sales to check the county's guidelines, we need to look at what assessment did the county's guidelines come up for these sale comps absent a successful appeal action. That's what I've listed in this column here, the pre-appeal values. So these are the 2023 values before appeal. This illustrates that for both properties that were reduced on appeal in 2023, the initial county guideline assessments were well above the sale price. And for the 2 properties not reduced on appeal, the assessment is much higher for one of them. Keep in mind, the county states that they grew apartment assessments by over 5% for 2024. So this 2023 pre-appeal value does not capture that growth, which would make the 2024 guideline assessments even higher than the sale values. Taken collectively, these 4 2024 sales, looked at as the county initially assessed them with the guidelines, came in at an average of 9% above the sale price. This is, again, before any adjustment. The county made a 5% on average adjustment across the board. Now, if we did incorporate that adjustment, the sales would be 12% lower than the guideline assessments. So what we see from the 2024 sales is that the guidelines as applied to properties that have not been reduced on appeal overstate value by at least 9%. Of the 4 2024 sales, the guidelines would have overassessed 3 of them. So 75% of the time, the guidelines are above the sale price. And when they're over on those 75% of cases, it's by an average of 12%, which again doesn't incorporate the 5% year-over-year growth the county applied on average across the county. Now, this 12% excess assessment figure is interesting because that is exactly how much the county overassessed the 2023 sale of the Jasper on Columbia Pike for this tax year. As I'm sure the board recalls, the Jasper sold in July of last year for $105 million and was assessed with the county's 2024 guidelines at $118 million. That is 112% of the sale price. Upon appeal, the county revisited the income and expenses at the Jasper and was only able to revise the value down to $112 million with the current guideline cap rates. This clearly illustrates the county guidelines are not capable of accurately capturing the market because the cap rates are simply too low. Further, the Jasper is a quarter of a mile west from the subject property. The Jasper and the subject were both built in 2009. The Jasper sold for $390,000 per unit. The current assessment on the subject is nearly $460,000 per unit. Our appeal value is still $439,000 per unit, well above the comp, but closer. So knowing the county guidelines result in values higher than the market in the majority of cases, what should the appropriate cap rate be? On page 4 of the county's 2024 guidelines, the county states their own cap rate methodology to apply to sales. We applied that methodology to the sale of the Jasper, then compared the result with the guideline cap rates the county applied to that same property. The difference was just over 20 basis points, which is what we have used in our analysis. This is shown on page 39 of the Wilkes-Artis Board Book. Now, another note on the sale of the Jasper, that property sold in 2016 was the prior sale. So a 7-year hold period. That property over that 7-year hold period appreciated. It sold in 2016 for $102 million, 2023 for $105 million. That's a rate of return per year of 0.4%. Thank you.
Okay, thank you. Ms. Shuttlesworth for the county, please.
Yes, good morning, everybody. So the subject is a mid-rise apartment built in 2009. It has 188 units and almost 51,000 square foot of retail space. It was inspected by Ms. Roskin in July 2023. The amenities include fitness center, swimming pool, business center, community center, rooftop deck with barbecue area, and storage units. And the agents disputes potential rent and the cap rate. So the property was purchased in August 2021 for $80,100,000. And that's why we don't have the INE for 2020 on the summary sheet. And years 2021 and years 2021 represent only partial year, which is August through December. The 2023 apartment income increased by 5.92%. The net operating income reported in 2023 increased by over 11%. The 2023 vacancies and collections were at 4.4%, and we applied stabilized vacancy of 6%. In our column F, we decreased the potential apartment rent. And here's what I wanted to point out to the board. On the summary sheet page, you can see the rent information that was provided to our department. The rent information provided included only the minimum rental fees. As you can see, information provided by the appellant indicates we use those minimum rental fees, and they add up to over $5.2 million. So that is the potential rent they reported, what was provided to us. Now, in our test column F, we used much lower number than that. So our number is even lower than the minimum rental fees they're charging. So I just hope the board members can see that it is truly not our intention to increase these rents projections to the highest possible level. That's hardly the case. We projected only 107% increase in NOI. Again, the 2023 reported NOI increased by over 11%. In respect to the retail portion, the rent roll provided to us indicated the average rent per square foot of $31. We tested that the retail portion in column F2 and much lower rate, which was $25.80, as we recognized the excess vacancy, which was almost 24%. Our tested OPEX ratio was also higher than the OPEX reported by the appellants in the 2023. Our cap rates are expressed in ranges, not as a single number. They depend on the property type, the effective age, and the proximity to the closest metro station. And for this property, we have our unloaded cap rates range from 4.24% to 5.09%, and loaded cap rates range from 5.25% to 6.10%. They're supported by third quarter publications, various publications which we provided to the board in our package. And these are PwC National Apartment Overview, which provides cap rate range from 3.75% to 8%. Then we have PwC for Mid-Atlantic region, showing cap rate range from 4.25% to 6.5%. And lastly, RERC, the third quarter East investment criteria shows the range of 4.5% to 9.3%. And the sales Mr. Harmon just shared on his screen, they include 2024 sales, but we did not. I just want to stress, we did not use 2024 sales. I mean, in our 2024 analysis. This was just a sheet prepared by one of us on our team just to show the board how the sales ratios have been trending for the past few years and how do they look for 2024. Just like Madam have a crystal ball, but those 2024 ratios will show us which directions we'll be heading during our 2025 analysis. And that was all. That was the whole purpose of that sheet. Thank you.
Okay. Questions from board members? No? All right. Any final comments, Ms. Shuttlesworth?
Yeah, so again, we're dealing with the property which has shown the increasing NOI. The 2023 NOI increased by 11%, 11.5%. Our tested OPEX is higher than the OPEX used by the appellants in their projections. Our projected NOI increase is only 1.07%. And I recommend that we confirm the subject's value at $86,280,800. Thank you.
Okay, thank you. And Mr. Harmon, if you take a minute to wrap up, sir.
Yes, thank you. So the county cited PwC and RERC, two surveys as support for their cap rates. It's important to understand what these surveys are. PwC is for the Mid-Atlantic region, which of course includes DC, and it is institutional investors surveyed about institutional grade properties. Knowing that institutional grade properties are the newest, best located, best amenitized properties. That would be your brand new properties in DC. That would be your Penzance Highlands properties in Roslyn. This property built in 2009 on Columbia Pike is not the best and latest best amenitized. You need to make adjustments to the low range of that. Once you make adjustments, the county's cap rates are not supported. Same thing with RERC. RERC provides 3 tiers of cap rates. First tier is what the county is using. First tier are brand new buildings in the best locations. That is not appropriate for this property. 2009 build on Columbia Pike. Second tier cap rates, the cap rates are much higher in RERC than what the county's used. Thank you.
Thank you both. All right, it's just among the board members. Where's everybody on this? Mr. Hoffman.
Hi. Just one thing I kind of agree with the appellant on here is the last statement about cap rate ranges and institutional quality apartment buildings. One thing I've seen is, if you're under 200 units, that's kind of a ding on you as far as institutional owned apartment building. It's just less efficient to operate. Big buyers that pay top dollar are looking for something that's kind of 200 or more. And so kind of the other thing is if it's heavy retail, it which this is, I mean, there's 50,000 feet of retail in this building, so it really eliminates a lot of institutional apartment owners and REITs because they simply just can't have that ratio of retail in their portfolio. So what I'm getting at is if you're looking at the lower end of the cap rate range, it's really for those properties that tick all the boxes as far as over 200 units, well located, next to transit. You've got minimal to no retail, and then you're going to get an apartment buyer that will come in and do a sub 5 cap rate still. But kind of given that long-winded explanation, I made a minor adjustment to the cap rate. I just think I can't see somebody paying under 5 for a base cap rate for a building with this much retail in it. So, I made that adjustment. I just took it to 5 as the base rate, and I ended up with A minor reduction, is still higher than last year, but 84,634,100.
Okay. Other folks? Mr. Metzger?
Quite briefly, I agree with that analysis a lot. I generally don't like to fool with cap rates, but I also have been convinced over time that we can make exceptions when exceptions are due, and this is, I think, legitimate in that regard.
Okay. Mr. Lawson?
Yeah, I kind of looked at this different. What I did, and I concentrated on the apartments. But what I did is figured, okay, I looked at the increase in the assessed value, and it looks like the monthly rent for every unit would have to go up by over $100. And I just don't think that's achievable. And so I think that the county's increased in the assessment just might be a little too aggressive.
Mr. Penrod or Mr. Yates?
Uh,
Mr. Penrod?
I'm not sure if I agree with Mr. Lawson in that. I mean, the rates based on what we have here and what they were disclosed, yeah, they might seem a little aggressive, but based on what they're currently asking and what the rates are on the on site, they're much higher than what their county's using. Because that was the first thing I was trying to do, adjust maybe the rates on the what the county has used, but after looking at what they're asking for and what vacancies they have, which is very little, I'm not convinced that it should be decreased.
Mr. Lawson?
Yeah, Jose, what I looked at was the 3-year operating history. And I took the 2023 and then I compared it to the 2024. And so for the total potential rental income, you'd have to go up by, I came up with about 131 per unit per month. And I just don't see that, but maybe it's there.
Mr. Yates?
Well, Barnes, what adjustment do you see making then at the bottom line?
Well, I think that the increase in rental that we're experiencing in Arlington is robust, and properties are filling up. But at the same time, the interest rates have dramatically increased, and I think it's an offset. So I think probably either go to what the assessed value was last year, or maybe even a little lower. But Greg, where were you? You went so fast, I missed
Sorry.
writing it down.
84,634,100.
So you went below last year.
No, I
No.
had 82 was last year. Am I
Yeah,
wrong there? It's an increase from last year.
Right.
Oh,
I don't think it
okay.
went down
it's
from last year.
splitting between the two.
Yeah, it's basically in the middle.
Yeah. And you're doing it based on cap versus the revenue. I saw the revenues a little off, but
So Greg, you're 84,634,1.
100, yeah.
All right.
I could do that, but I see it more, not as on the cap as much, although I'm starting to understand the cap better with everything I've been hearing. But I see it on the revenue side. I could do the 84. I don't know where anyone else stands.
All right. Mr. Matskin, can you live with that? Mr. Penaranda?
I'm not in favor of reducing based on cap rates.
Mr. Lawson?
Yes, ma'am, I would be okay with that.
Okay. All right.
All right.
Mr. Hoffman, would you like
Yeah.
to make a motion?
I'll make a motion to reduce to 84,634,100 by increasing the base cap rate to 5%. Unloaded.
Okay, we've got a motion. Do I have a second? Mr. Matskin is a second. All in favor? Aye. Opposed? Okay, it is 5-1 without Mr. Penaranda. The assessment's reduced to 84,634,100 based on adjusting the cap rate to a flat 5%.
I'm sorry, was Mr. Yates in favor or against?
I was in favor.
Yes.
Okay, thank you.
Okay, the final case on the agenda is RPC 1500502A at 1947 North Yule Street. Mr. Harvin, you can start with your 8 minutes and tell us about this property.
Yes, thank you. So this is the Verde Point Apartments. They're located north of I-66 across from Roslyn. They were built in 2015 and consist of 198 units. The issues on appeal are again the potential rental income and the cap rate. You'll see on the county's test page, the current assessment imputes a potential rental income that is 4% higher than what the property achieved in 2023. The test column lowers this increase to a 2% increase over 2023 levels, but then offsets that adjustment by lowering the operating expenses as well. Now, again, under Virginia law, actual income, expenses, vacancy, and collection losses at the property are required to be considered. The county was provided this information, the 2023 financials on 2 occasions, on March 15th when the INE was filed by the owner, and then again a month later, April 15th, when the appeal was filed. The appellant's pro forma column uses the actual 2023 income, expenses, vacancy, and collection loss that the property generated in 2023. Next, for the cap rate, as we discussed, the county also includes 2024 sales in their case on page 30 of this board pack. Now, this is the second case for us now, and we've seen others where the county has relied on 2024 sales to support their assessments. This is a trend, and we need to be sure to apply this methodology to office properties in the county as well. Now, as I demonstrated on the last case, of the 4 2024 sales comps, 2 were reduced on appeal in 2023. In order to check the guidelines, we need to use an assessment created by the guidelines and not created on the basis of an appeal action. So if we go back to the 2023 pre-appeal assessment values, and not even growing that by the 5% the county states multifamily assessments grew for 2024, we again see the county's assessments are much higher than the sales price on 3 of the 4 sales. 75% of the time, the county's assessment, not even accounting for the year-over-year growth, was higher than the sale price. Now, on those 3 sales, the 75% of sales where the county's assessments are higher than the sale price, the county's assessment is an average of 12.5% greater than that sale price. If we include the 4th sale comp where the county was at or below the sale price, the overall average of those 4 sales comps is 9% above the sale price. So the county's assessments overstate the value 75% of the time. And on average, across the 4 sales that have occurred, they're 9% higher than the sale price. Now, the reason they're missing 75% of the time is because the guideline cap rates are simply too low. Again, we saw this on the Jasper. We discussed it last case, sold for $105 million in July of last year. Current assessment came in at $118 million. Upon review, with no adjustment to the cap rates, the closest the county could come to that $105 million sale price was $112 million. Simply stated, the guidelines cannot accurately capture the market with the current cap rates. Now, looking at the surveys, the county cites as support for their cap rates. We see that PwC, again, it's a survey of institutional investors regarding institutional grade properties in the Mid-Atlantic region. We've discussed institutional grade. Of course, it means the newest, best located, most amenitized buildings. This property, again, is across 66. It's not metro accessible. It's in a secondary location. It's nearly 10 years old. Does not have the best amenities as we observed on the 2023 inspection that we conducted with the county. Also, the Mid-Atlantic region, of course, includes DC. DC properties generally sell at higher values and lower cap rates than properties in Arlington. So an upward adjustment to that range, to the Mid-Atlantic range, is necessary to make it applicable to Arlington County properties. Given these parameters, the county's low end of cap rates still comes in below what the unadjusted PwC range is. The low end of the county's cap rates, if you look at their 5.25% loaded rate and you subtract 1.03% for the tax rate, you get to 4.22%. That's below the low end of the PwC Mid-Atlantic institutional grade range, which is 4.25%. So essentially, the county's guidelines are saying Arlington County apartment buildings are better than everything in the Mid-Atlantic region. The PWC range, once loaded for the cap rate and the replacement reserve rate, is 5.282% to 7.532%, with an average of 6.12%. For this property, the county uses a cap rate of 5.5% for market apartments. This compares with the low end of the PWC range loaded for the tax rate and replacement reserve rate of 5.282%. Add in the county's metro adjustment and we get a cap rate of 5.532%. Essentially, the county has assessed this property as if it is one of the absolute best properties in the Mid-Atlantic region, newest building, best location, best amenities. We know this isn't the case. Going to the other survey that the county cites as support, it's the RERC survey. Again, we see there's 3 tiers that RERC provides, and RERC does, the region is not Mid-Atlantic, it's East Coast is the one that our location falls in. But within these 3 tiers listed on the survey, first tier, the RERC survey defines it as new or newer quality construction in prime to good locations. Second tier is defined as aging, former first tier properties in good to average locations. Third tier is defined as older properties with functional inadequacies and or in marginal locations. Now that we know these 3 tiers in the RERC survey, we can choose the correct one for this property. This property fits in the second tier. RERC's second tier cap rate range for East Region apartments is 6.532% to 10.332%, with an average of 8.732%. The assessment uses a cap rate that is well below the RERC survey range. So the preponderance of the evidence, the standard in Virginia, the preponderance of evidence, we have 2023 sales, Jasper, Columbia Pike came in over a 6% cap rate. We have 2024 sales that the county has included in their board pack illustrate that the county's cap rates are too low. We have the PWC survey, once adjusted for non-institutional grade properties and non-DC prime location, supports higher cap rates. The RERC survey, once we get out of the first tier and go into the appropriate tier, supports higher cap rates. All of these data points illustrate that the county's cap rates are too low. We have proposed a cap rate based on market sales in 2023 in Arlington County. This analysis is provided on page 39 of the board book. Thank you.
Thank you. Ms. Shuttlesworth for the county, please.
Yes, so this is a mid-rise apartment building built in 2014 with 187 market units, 11 committed affordable units, and over 16,000 square foot of retail space. As the board can see, the INEs for 2021 represent only 1 month worth of operations, and this is because the property sold on November 2021 for $106 million. We have it currently assessed at $93,974,000. We had to separate, so this is busy looking spreadsheet. We had to separate again the market units from the committed affordable units, and then we had to add another column for the retail space. So I guess the easiest way to look at this spreadsheet is to look at column E, which is the 2023 INE provided by the appellants, and our tested column F3, which has all cumulative numbers for both CAF market units and the retail. This is exactly how the appellants submitted the INE. They just lumped together all components for this property. The amenities include secured lobby, 24-hour concierge, mail and package drop-off center, barbecue area, pet wash station, outdoor fitness area. Again, the appellants are contesting the cap rate and the potential rent. As the board can see, the 2021 INE for both residential and commercial components represent only 1 month of operation. I just wanted to stress that for 2022, the appellants provided separate INEs for both components, with total NOI shown in column C1. The 2023 INE survey combines residential and retail component, and it shows the rent apartment increase of 2.46% and NOI increase of 3.8%. The total vacancies and collections reported for 2023 was at 5.9%. We have applied stabilized vacancy at 6%. And also during our 2024 analysis, we overestimated the potential rent for apartments, but we also overestimated the OPEX. But you can see our cumulative OPEX ratio in column F3 is at 23.5%. This is what the tenants, the appellants reported for 2023. And our test column F3 represents, two cumulative numbers for both. So again, it's probably the best idea to compare column E to column F3. Per our 2024 guidelines, we applied 5.5% cap rate for the market units and 6% cap rate for the CAF units and 7.3% cap rate for the commercial component. And our cap rates are expressed in ranges. Again, as I stated before, they depend on the proximity to the metro station, the effective age, and the type of the property. And again, our unloaded cap rates are between 4.24% and 5.09% for the apartments, and loaded rates range between 5.25% and 6.10%. And again, we provided third quarter publications for PwC and RERC in our BOE packet. We could not use the fourth quarter publications. Again, these were not available to us during our 2024 analysis. And we will be facing the same problem this year when we value 2025, when we value properties for 2025. And that is all. I'm open for questions. Thank you.
Okay. Questions from board members? Mr. Lawson.
Do a number of these units have views of DC and Georgetown? I guess I'll ask whoever knows the answer.
Can you repeat the question, please?
Yeah, don't a number of these units have nice views of Georgetown and DC?
Sure
I can
they do.
check my notes from when we toured it.
The reason I ask is I represented a property owner to the west of this, and that's what they were griping about. It was blocking their views of the district.
I'm not sure that's germane to this issue, but other questions from board members? No? All right, Ms. Shuttlesworth, if you take a minute to wrap up.
Yes, so based on the 2023 INE, we overestimated the potential rents. We also overestimated the OPEX. We tested lower potential rent in column F and column F2. When you look at our cumulative test column F3, again, you will be able to see that our projected increase in rents is less than 2%. Our projected NOI increases 1.9%, while the property experienced increase of over 3.5%. The retail space was 100% occupied. And again, the property was purchased in 2021 for $106 million, and it is currently assessed at $93,974,000. And I recommend confirming the subject's 2024 assessments. Thank you.
Thank you. Mr. Harmon, if you take a minute to wrap up.
Yes, thank you. November of 2021, when this property sold, was the height of the market. That is before interest rates increased beginning in March of 2022. That is before Arlington saw this explosive growth in supply, 20% increased market supply. So that 2021 sale is a completely different market than we find ourselves in as of the date of value this year. The county's current assessment is 2% higher on NOI. We saw in the first few cases this year that the county did follow the dictates of Virginia law and came in using actuals. They came in right at the actual NOI. On this property, they're 2% above. The cap rates are not supported. The county cited Q3 2023 surveys. Those do not support the county's cap rates. That data available, Q3, Q2, Q1, none of it supports the county's cap rates. We relied on the same data that the county had available to them, specifically the Jasper, Columbia Pike, was not considered. The county's cap rates are too low as indicated by 2024 sales that they have provided in their packet. Thank you.
Okay, thank you both. All right, it's just among the board members. Mr. Matzkin.
I have a couple of comments, but in my head, but I'm only going to make one. And that is, I used to live in this immediate neighborhood, and I've had until very recently investment property in this immediate neighborhood. And I and my neighbors and my tenants and everybody else consider this metro accessible, not non-metro accessible. Therefore, according to them and me, the cap rate should be lower than this. I'll make one other comment. That offsets my gut feeling that although this assessment is higher a bit than what we've seen, almost 6%, nonetheless, the cap rate more than makes up for it and therefore must justify it, again, based on my personal experience. So I'm supporting it.
Okay, Mr. Hoffman.
I had a kind of a smaller adjustment to the cap rate. I think it fits the box a little bit better than some other properties, but it's still, you know, I don't see it as a 4.5 cap base rate. So I'm using, I didn't touch any retail. I didn't touch the committed affordables. I just looked at the market rate units column that the county has on the test and just took that NOI and adjusted the rate cap rate to 5.8 loaded. So that's a 4.75 base cap rate. Slightly above treasuries. So anyway, I got just a little bit higher than the appellant. 89,736,400 is the total. And I do agree that the sale was at the absolute top of the market for apartment buildings.
All right, I did something. I'm just trying to get my math here. No one's going to like it.
Is it an increase?
No, decrease, but no, well, I just looked at this and thought, rather than getting into the cap rate, if you just look at the combined NOI, you were looking at 5,069,000, then we went to 5.2 million, and the county's using 5.3 million, which is $100,000 more. I mean, that caps out at 1.8 million. That I think it's too high. And not knowing, it's hard because the appellant doesn't split it all out into what portion goes to what portion. So I just took it off of the 5.5, just coming off the apartment income like that you had done, Greg. And that brings it down to 92,157,6. If we don't feel it's special enough to adjust the cap rate. Go ahead, Mr. Lawson.
Yeah, that's the reason I was asking about the views is I looked up this project and there's a whole lot of pictures, and maybe it's somewhere else, but it looks like they're views of Washington, D.C. from these units. And I'm just going to read one comment from one resident. From the interior design to the amenities makes it the best community I've ever seen in Arlington. The location is also great. You can see a lot of green from every window. And it seems like this is a superior product. And then, so I take that concept and then, and yet I know that no matter how superior it is, we still do have the interest rates being where they are. And I think, I guess all this discussion is going to lead me to say that I would agree with Mary's adjustment. I don't think it should go down much. I think it should just go slightly down.
I could go with you, Mary.
Mr. Yates?
I was fine with the original county test, but I mean, I could go with the adjustment, but I don't see that I think going forward, I think the county's test they're very close. I just didn't find enough reason to adjust it.
But the test actually went up
Yeah,
$100. Yeah, other than, and I would agree with you, except for the combined NOIs is $100,000 higher than 2023 and 2022. Doesn't seem like a lot, but that's a lot of money.
yeah, and it is moving that direction. But I can go with your adjustment, but I'm not. It's a weak decision to do so.
I'll take a weak decision. Okay, Mr. Matskin, where are you?
I was afraid you might ask. I agree with your analysis, Mary, but I'm still stuck, especially because I think getting close to 6% seems a little increase year over year seems a little bit high relative to what we've seen. But again, I'm stuck on the fact that I think this is metro accessible, so the cap rate's higher than it ought to be. So I'm probably stuck on my initial assessment that it ought to stay where it is.
Okay, and Mr. Penaranda?
I'm okay with the original assessment. I mean, I think Ms. Shuttlesworth did a very good job putting all these numbers together, comparing, and coming up with pretty much, what the assessment was to begin with. So I'm okay with the original assessment.
Okay, I don't know whether this will give anybody any ease, but so it's still an increase of 3.3 million, which is a 3.8%, almost 4% increase.
Yeah.
Yeah, I'm flexible.
No, but that's what I'm saying, to adjust it down, so.
Yeah, Ken, it's I mean, this thing's telling me 45 minutes. No, maybe this isn't right. I was just looking at the walk time to the Roslyn Metro. This can't be right.
No, it's a little over half a mile maybe, but you can observe, again, this is soft stuff I'm talking here. You just see
20
people,
minutes.
between Adams and Danville Street, walking across Langston Boulevard, going to Courthouse Metro. Having said that, Metro certainly in the last couple of years isn't nearly as important as it was back in the day.
Sure.
Yeah.
So, I can be, that's why I said I can be a little bit flexible. I mean, people just don't care as much. I agree with Barnes. It certainly is a quality property, good views, lots of green, a little airplane noise from time to time, but it's a nice open environment, and the townhouses and others around it are quite nice. I don't think this is a class 2 or B property as the appellant has maintained, but I mean, with arm twisted in a very friendly and soft manner, I could support Mary's position.
All right, well, with that being said, Mr. Metzgen, then I'm going to move to reduce the assessment to 92,157,600 based on taking the difference off of the market apartment portion of it.
Second.
Okay, I have a motion, a second by Mr. Hoffman. All in favor?
Aye.
Aye. Opposed? Okay, so it is 5-1 without Jose or Mr. Penaranda. The assessment's reduced to 92,157,600.
Thank you.
Everybody.
Thank you all.
Okay, does anybody else have any other business? Okay, but then we will stand adjourned here at 10:40. Reconvene tomorrow morning in person for board members at 9 a.m. In the same place. And then Mr. Hoffman, if you can stay on for a minute.
Yeah.
Just one brief thing for you, and then everybody else can go about their day. Thank you. Bye-bye.
You know what, Mary, to your point, I forget.